Time for hot picks. We're calling them small caps because by US standards they are. Our guest has some ideas. One company that makes street sweepers, sewer cleaners, and road marking vehicles. Let's get more from Dan Skubiz, Senior Portfolio Manager at FM Investments. Thanks very much indeed for joining us, Dan. Really appreciate it. Let's get into your first idea here. Federal Signal. What do they do? What attracts you?
Yeah, good morning, Andrew. I think, you mentioned some of what they do in terms of street sweeping. They also do safe digging, sewer cleaners, road marking vehicles. And then they also recently bought a manufacturer of refuse trucks or garbage trucks. So as an example of their M&A strategy, they own a number of businesses in Canada, including a business called Joe Johnson Equipment, which distributes various equipment. And they see that as an opportunity to grow the new refuse truck distribution within Canada. So more broadly, we're seeing more steady demand from cities and utilities, plus tailwinds from U.S. infrastructure spending, which still has a ways to go. So this is a very strong, experienced management team that continues to raise the bar on margins. And they're seeing, expanding their backlog and have successfully incorporated some of this M&A into the business.
Sorry, what was the Canadian connection that you mentioned there?
Right. So they own a number of businesses in Canada. And so when they made this acquisition of the refuse trucks, for example, and they've done this with a number of other businesses that they have a business called Joe Johnson Equipment, which is a distributor of equipment. So they can bring some of these new acquisitions, the vehicles from the newer acquisitions and bring them into the distribution network within Canada to grow that demand grouping within Canada.
Your next idea is ESCO. Among other things, it's a supplier of aerospace components, and it could be a winner if defense spending goes up.
Yeah, I think there's a number of ways for ESCO to win. I mean, I think they're very under the radar from a investor knowledge base. I mean, beyond the aerospace components, they have defense systems, and then they also do utility grid testing, and they have equipment within that end market. So these are all critical areas with high barrier to entry niches that have strong secular tailwinds. So, their benefit is benefiting from commercial aerospace growth, defense spending, especially on space and naval programs, including submarines, which is a big area for them. And then they're also benefiting from grid modernization, which covers not only electrical utilities, but as well as the renewable space. So this is a little bit newer of a management team that took over a few years ago, and they're just starting to hit their stride. In addition to the usual blocking and tackling that they're doing, they've also undergone a portfolio update where they've trimmed some of their lower margin businesses and focusing on some of the higher margin segments through both organic and inorganic means.
And then finally, a very different company, Ligand Pharmaceuticals. Where do they fit into the pharma industry?
Yeah, Ligand is a really interesting company. So they're essentially a biopharma royalty and licensing company. So they develop or acquire drug discovery platforms that are offered to biopharma companies, and then they collect a milestone or royalty payment as their partners advance their products. So as an example, their most important technology is something called Capizol, which is a chemical compound that helps drugs dissolve and be delivered into the body more efficiently, kind of like an ingredient that makes a drug stable and usable. So they're not developing the drugs, but they're providing these ingredients for their partners that are using these compounds within their drugs. So it's a very diversified capital-light business model that has strong cash flows and earns from dozens of partner programs without that risk or cost of running their own clinical trials. So, we see, their royalties coming from a broad set of smaller partner drugs, none of which are big enough to get hit by the Medicare price negotiations, which look at anything that's less than $1 billion in gross sales. So we see it as more insulated from a policy headwind that's pressuring the big pharma names.
I couldn't quite understand. You say it's capital light, so they don't do this research or development themselves?
Correct. So think of it as they provide ingredients to biotech or pharma companies. So as an example, I mentioned Capizol. So it helps make drugs stable and usable. So lots of drugs need that type of compound within their drug, in addition to kind of, the secret sauce of that drug that's going to, provide the benefit to the end user. And so they have these compounds that need to go into a lot of different drugs. And so instead of each of their partners developing and creating that on their own, they can come to Ligand to license that ingredient, and then Ligand in return gets royalty and royalty payments as those drugs develop and make pass the regulatory hurdles.
It's interesting. Sorry, royalty financing. You say that there's been something of a drying up in venture capital, you said, for pharma, and so this makes this royalty option more attractive?
Yeah, absolutely. I mean, with that lower VC funding, as rates have gone higher, that just makes Ligand's business model that much more attractive, because these companies, and a lot of them are smaller biotech companies, don't have to put up that upfront payment and cash flow, and so they're only paying if their drug succeeds, and that's a benefit for them from a cash flow perspective, and it's a benefit for Ligand as they partner with these other companies to be able to benefit from the upside of the drugs.
Dan, thank you very much for joining us. 3 names, fresh names. It's great to kick off the week with that. Three new ideas. Dan Skubiz, Senior Portfolio Manager at FM Investments.